Welcome back. Okay, now we're going to show you how the income statement, balance sheet, and cash flow all tie together. And it's a little tricky, but it's very cool the way it works out. So let's start with the income statement. So as you can see here, these examples might be slightly different than what we had before. But let's just show you. So this is for the year of 2026, and we're going to see in our income statement, we have revenues of 60,000, some cost of goods sold, a gross profit of 30,000. We've got our operating expenses here. When you net those out, we get to an operating income or EBIT line of $18,000. We have $30 of interest income. It gets us pre-tax income. Then we have our taxes that we're taking out, and that gets us our net income level. And that is just a basic income statement. I had a kind of lower income tax level than probably is appropriate, but let's just go with this for the sake of continuing. Now, this piece down here that I'm blocking in, this is something that's often shown in income statement. If you've heard the reference of EBITDA. And basically what EBITDA is, the EBIT is the earnings before interest and taxes, which is the operating income line, essentially, right here. And the DA is the depreciation and amortization. So we've gone over what that means now. So the idea is the EBIT is pretty much what your operations are, right? It's before your interest, income, or expenses, which has to do with financing really, and taxes, which is also different. So you take this EBIT line and you add back the depreciation, in this case $600, and you get your EBITDA line of 600. So people a lot of times will talk about the EBITDA because it's kind of like the cash other than the depreciation, which is non-cash expense. It's kind of what's going on a cash basis roughly for business. That's the EBITDA. In this case, they earned 18,600. The other thing that's become quite common in the public markets is stock-based compensation. So again, a lot of companies will pay a lot of their expenses, which you'd see in here, that they didn't actually pay out this money in cash, some of it. They actually paid it out in stock, right? You work at Tesla and you get Tesla shares, and there's value to that, obviously, but there's no cash changing place. So a lot of companies will add back that stock-based compensation to get an adjusted EBITDA. Um, and in this case, let's say the stock-based compensation was $100 of compensation that went out as stock. And so you can, if you're going to ignore that, you would say the EBITDA adjusted would be 18,700. Now, some people will think this is fair. Other people will say it's not fair because obviously, if you take it to an extreme, if you paid out $10,000 worth of stock, suddenly you're making the adjusted EBITDA look way more reflective than what the business really requires because you're diluting the shareholder base significantly. Well, we can get that later if you're a little confused by that. Anyhow, so that's our income statement. Now let's look at our balance sheet. Our balance sheet, I have two columns here, right? 2025 shows what it was last year at the end of the year, and 2026 is showing what it's going to be at the end of this year. So this is like if I'm looking at a financial statement, they're showing me these numbers. And in this case, let's just walk through. Let's skip the cash line for a moment. So accounts receivable, if you remember, this means money that we're expecting to collect. Let's say in this situation that the accounts receivable went up from 1,500 to 2,500, right? You can see all these changes, and I'm gonna bring this back and forth between the balance sheet and down here the cash flow statement to see how these tie together. So, for example, when the balance sheet went up, when the accounts receivable went up by $1,000 right here, we're going to see that if we go into our cash flow statement. If you remember, we start with net income. All right. The first thing that happens was we added back the depreciation and amortization. That was $600, right? And that reflects the same $600 we're showing here. So we had $600 added back. We had the stock-based compensation of $100 we added back. And now we're going to do the change in these working capital items, which is like accounts receivable. So our accounts receivable, what happened? Well, I'm going to do a little thing here. It's going to show, it's a formula. It's basically taking what it was before minus what it is now, right? So our accounts receivable went up $2,500. Well, what does that mean? That means we're expecting to receive $1,000 more at the end of 2026 than we were at the beginning. So that's $1,000 less cash that came into us during the year. So we're reflecting that here. Same way, our inventory, okay, rose by $2,000. Well, why might that have happened? Maybe we purchased another $2,000 of inventory that we still haven't used. So that's $2,000 of less cash we have. So that comes out as well. And you see that here. So all these items that are in short-term assets or short-term liabilities, we have to, whatever the change is, we adjust for. When you're looking at the liabilities, the accounts payable, it's the opposite, right? So it fell by $1,500. So this is money that we had to pay out. We owed somebody $2,200. Now we only owe them $1,500. Well, that's because we paid them $700, right? And you're going to see that here, $700 coming out. And that's a simple formula. It's just going to be what it is now minus what it was before. Again, this is column E minus column D. When I was looking at the assets, like accounts receivable, instead of E minus D over there, it's going to be D minus E. So it's flipped, right? And that's just, we went through the example. And then accrued expenses is going to work same way as accounts payable. So again, we can see how that changed. And we can take all these items now and add them all up, and that gives us our net cash from operations is going to be 14,380, okay, which is different than our net income, which was 17,030, which I'm showing here also. Then we have our investing activities. Well, in this case, let's say the capital expenditures, and we'd have to just look that up, what they were, was $1,000. And you'll see that on the balance sheet. If we look at our equipment line, it was $6,000 and it rose by $1,000, $7,000 now. The depreciation, it's actually on the balance sheet a cumulative depreciation. This is a total amount that's depreciated over the prior years. So it used at the start of the year was $600. Well, during the year, we had an additional depreciation of 600, right? So 600 plus this 600 is going to get me 1,200 now has been accumulated. But we also bought $1,000 of new stuff. So now the net equipment line is going to be 7,000 minus 1,200 accumulated. So our net equipment now is $5,800, right? It rose from 5,400 to 5,800. Does that make sense? Well, we bought 1,000 new stuff, but we lost $600 to depreciation. So that's a $400 increase, which is exactly what it's showing. So again, it makes sense. So our assets now, just taking these two things together, the 33 plus the 5,8, and you get 39,530. Now our liabilities, we talked about the changes that already happened. Now the capital contributed, in this situation, the owner didn't contribute any new capital. However, the stock-based compensation of $100, well, that's really kind of like the employee getting $100 of value and investing it into the business, right? Because they got that it's money that's in the business now as opposed to them collected in cash. So that extra $100 is knocking up the capital contributed line. So that went from 5,000 to 5,100. Well, what happened to the retained earnings line? That is just an aggregate of all the cumulative net income. So as you see, it's going to be the prior net income, 13,600, plus whatever the net income was this year. Okay, and that gets me the new retained earnings line. And if I take those two together, I get 35,730. And now if I take my liabilities plus my equities, you'll see I get 39,530. And you'll see that 39,530 does match the assets. So the liabilities and equity do equal the assets. And then the last piece is when I look at all these cash flow statement items, I've got them all here adjusted. And at the very bottom, I'm going to just take, oh, well, I forgot to touch on this one other piece, which is, let's say we just sold no equipment, so that's 0. There was no additional contributions other than the stock-based compensation that we talked about. And then the change in debt. So I'm showing here $2,000. Well, how do I know that? Because the bank loan on my liabilities down on the back of my balance sheet, it went from 3,500 to 1,500. We paid down $2,000 of the debt we owed to the bank. So I see that here of negative $2,000. So you can see how the cash flow items and the balance sheet items tie together formulaically. Okay? And now, because they do all that stuff, and if you've done everything correctly, you're going to take your cash flow statement, take the operations and the investing activities and the financing activities, and I'm going to get a total change in cash of 11,380. And that 11,380, if you see, if I take the 11,380 and I add it to what the cash balance was before, I'm going to get what the current cash balance is, 25,980. Okay, so this is how the cash flow, income statement, and balance sheet all tie together. You can see there are different pieces from each of these three statements that are connected to the other statements to make them all connect together. And this is the key aspect of modeling as we go forward to understand what happens to a business as you make assumptions and predictions, and to understand what's going to happen to the cash, earnings power, and all sorts of things like that that we'll get into as we model a real business out.